Okay, traders, let's talk about broken winged butterflies today. What I'd like to do is give you some brief characteristics behind the broken winged butterfly, how to structure the trade, how to manage the position. So let's get right to it. So the broken winged butterfly is a little bit different than the normal butterfly. As you can see in this graph, I'm going to go ahead and show you what the trade looks like right up front, and then we're going to talk about it. So I want to highlight the difference between this and the normal butterfly. So let me go over here and grab a normal butterfly. Alright, so this is what the normal butterfly looks like. You see, both of them are defined risk trades, but this one is it's got defined risk on both sides. Normal butterfly, short strikes. Wherever you place the center your short strikes, you're going to go out at an equidistance to the right and to the left, and whether that's 40, 50, 100 points to the right or left, you're going to put your long strikes at an equidistant from your short options. Okay, so that's what the graph looks like for the regular butterfly, just to refresh you. And then again, here's the graph for the broken winged butterfly. So let's get into the characteristics. Alright, so again, it is a defined risk trade. You're going to have all of your risk to one side. Now we're primarily using puts in this. Probably 99% of the time we'll structure these trades with puts. So we've already talked about the difference, about the long options being at a different distance from the short strikes. That's what separates this from the basic butterfly. So you'll notice on this thing that we're relatively safe to the upside. This is on the SPX. So you can see the way we've structured this trade. This thing could rally another 100 points and we're good to the upside. So you know, guys, last 6 years, what has this market done? It's a few blips here and there, but predominantly it's just gone straight up. And when it gets locked into a straight up move, it never turns around. You guys know, you've heard me rant about that forever. It's the beauty of this trade right here. Alright, so you also notice the flat theta line. This makes for a really good trade to hold on to with an adverse movement. Hey guys, this break even here on the downside, you know, we're talking about give me just a second, get the exact, yeah, we're talking about 2089. This is 2089, so that's you know, what is that, 1179, yeah, roughly 80 points away from where we're at right now. The playground area here is much wider than in a normal butterfly. So we've got plenty of room to the upside where we're not going to do anything. Then we got this area to the downside that's where we like to see our profit target get hit somewhere in there before we have to do anything. Now I've seen the back-tested study on this. That's why I'm placing it in my account. You guys know how I am with back tests and validating everything. So this thing meets the mustard, passes the sniff test. No questions about how consistent this thing has performed over, you know, watch the simulation, the back-tested simulation for all the different strikes, and you know, placing this trade on it, the deltas we're placing it on, it just produces one of the most smoothest equity curves I've seen in quite a long time. So so this is a good trade. It's a good trade for retirement accounts. I will put this in my retirement account on a regular basis. We're going to talk about that in a minute. Alright, so that's basically how the risk profile graph looks. We know that it's a defined risk trade. We know that it's safe on one side, generally to the up, the way we structure the trades. Upside we don't have to worry about. Downside we'll worry about once we get to the break even. And then we've got this area in between here that just looks really nice area for us to play in. Alright, so now we're going to talk about how to structure the trade. Okay, 60 days to expiration. That's where I'm recommending we put this trade. That's where that back-tested study, that's what it's focused on, 60 days to expiration. We want to use this on stock market indices. Guys, you can use it on whatever you want to, but I'm not using the number of occurrences or the law of large numbers to trade this. I'm using one product, and I'm going to stick with things that we know very well, and that way we don't have to look around. So we have our vehicle. We trade this forever. It's a strategy. We just make strategy adjustments and move on. It's the beauty of this. So stay with the SPX or the SPY. And if you're uncomfortable trading the SPY, then go with the SPY, go with the RUT, the IWM, go with the NASDAQ if you want to, the NDX or the QQQ. So trade those, put them in your paper accounts and trade them for a little bit, get accustomed to them, but stay with those symbols right there. That's my recommendation. Alright, now how do we actually structure this trade? So we want to buy one of the 60 delta puts, we want to sell 2 of the 40 delta puts, and buy one of the 15 delta puts. Now you can dink around with like this farthest away put right here. You can go, I'd say, anywhere range of 20 to 10. So that's probably the range that you want to work in. If you're trying to get this thing to where you pay very little for it, mess around with this side of the trade. If you want to collect a small credit so that this end, no matter what, you're going to make a little bit of money on, that's perfectly fine too. So, but that's the trade structure right there. As hard as it gets. Now what I'm going to do is I'm going to place this trade in my retirement account the day after the monthly expiration. It's just a mechanical trade for me. It's the same thing I do for the iron condors. Regardless of market conditions, I just place those trades. So we're going to do this one the same way. I'm going to trade it small. Guys, it's very capital efficient. It's like the regular butterflies. You can see right here in this trade that our max loss on this right here is $6,510. Okay, so you can see the max profits $5,000, and we're trying to take profit target around 25%. So 25% of $5,000 based on 6,500 of risk. That's a pretty good risk reward trade setup right there. That's what we typically expect in the butterflies, of especially if we don't make any adjustments and we keep the same capital allocation and we hit that profit target the majority of the time, which we're going to. It's a really nice return, and I've seen the back-tested study done on these strikes right here. That's what the back test is all about, is how well this thing performed with that particular trade structure. Alright, again, max profit on this trade is a little over 5,000. So with the max loss 6,500, it's costing us about that much to put the trade on. I think you're very, from a capital allocation standpoint, without me trading this thing a lot, I would say you're probably safe putting one of these trades on at the 60 days to expiration cycle. Put one of these on every 30 days, going 60 days out. I think you can do that as long as you have a minimum of $50,000 in your account. You can keep that cycle constantly going, and that will allow you to play the other high probability trades that we have in a retirement account, which is our iron condors. So those two should kick in, start working together, and hopefully we'll get to that upper end of that 6% a month in our retirement accounts. All right, so let's look at how to manage the position. First thing is we want to take profits at 25% of the max profit. So we're going to use the $5,000 number as our max profit in order to arrive at our 25% profit target. So the intriguing thing about this is you guys know how these markets get locked into these rally modes. So if we get into a rally mode and this thing just goes straight up, or grinds higher, normally it makes a couple of thrusts up for about a week or so, and then it grinds higher for like 40 or 50 straight days. Typically the market's characteristic these days. So my initial plan is to let this thing rally. If it does, we get up into this area. About 30 days to expiration, I'm going to look at selling a call spread against this. Now you could sell a call spread against this the moment you put it on. There's nothing saying you can't. That's something I want you to play with when you queue this thing up. Look at selling a call spread, maybe at the 1 standard deviation mark out in the same expiration cycle you're putting this trade on. Just see how that looks when you queue it up. But that's my plan. If this thing rallies, we get up in here 30 days to expiration and we'll sell a call spread against it. Let me clear this out, guys. If we get closer to the break even on the downside, what my plan is simply to reassess. I'm going to look at all of my options. I'm going to look at possibly rolling the short strikes and the long strikes in this trade here out to another 30-day cycle to buy me some more time. I'm also going to look at adding another butterfly, maybe an at-the-money butterfly at this level right here. I'm just going to look at closing the position altogether. There's no harm in that. If you're going to be putting one of these on every 30 days, we want this trade to enhance our non-directional high probability of success trades. So I'm looking at this more as an enhancer to what we already have going. So if I get into a position where I'm close to break even and this thing gets down to the short strike on the low side, yeah, I will probably look at I'll certainly entertain closing it out. So that's how I'm kind of looking at this. All right, I think that's basically it. Those are the only points I wanted to get across in this new trade that we have. So we'll queue it up Tuesday night during our sessions and kick it around a little bit. Look at some variations. Look at maybe putting selling the call spread against it, just so we talk through how that changes our P&L graph. Look at the downside. Maybe we'll queue up an at the money butterfly just on the downside right there at the break-even point, just to take a look, see how that looks. So anyway, that's it for the trade, and we'll talk about this more Tuesday night.